Welcome back to EDS, and in this video I'm going to show you how to turn your small account into a large account. And we're going to be using futures, we're going to be writing options contracts. Doesn't matter how small your account is, I'm going to show you exactly what to do step by step on what you can do to emulate a larger account, and then in doing so you will in time turn your small account into a large account. So the first thing you want to do is just go over to your watch list, your futures watch list, futures with options, because of course we're going to be writing options contracts. Now the reason why we're interested in futures is because it's very capital efficient. It's the way that the margin requirement is calculated is different to equities. Futures margin is calculated based on what's called span margin, and long story short, it makes your positions are much more capital efficient, giving you much higher returns on capital, while still having high probabilities of success. So this is our watch list for futures with options. You simply just want to list everything from high to low IV rank. The highest IV rank right now is the Canadian dollar futures. You've already got a position on, so we're not going to look at that. But the next one down is the Aussie dollar futures with an IV rank of 66.9. If we just have a look at the chart, we don't trade based off of the chart, but just to give you a visual representation of where we are with respect to previous price movements. The Aussie dollar has had a pretty steep move down, and typically when markets move down, volatility moves up. So that's good for us. Now, what we're going to do is go over to where we can see a list of expiration dates for the Aussie dollar futures, and we want to pick an expiration date that's between about 30 and 60 days out in time. So we've got 56 days here on the Aussie dollar futures, and what we simply want to do is sell one call and one put. We have our horizontal orange line that shows us where the price of the Aussie dollar currently is with respect to the strikes. We have our vertical orange bar that shows us the expected move, and we want to be in and around the one standard deviation level, which we can see with these dotted blue lines. So we want to be in and around the one standard deviation level outside of the expected move, and we also want to be anywhere between about a 15 to 20 delta. So we've got a 16 delta on the call side, and we also have a 17 delta on the put side, which as you can see lands us outside of the expected move. We're sitting just on the edge of the inside edge of the one standard deviation level, and we are within our delta ranges. And what you'll notice is if you look in the bottom left corner, we have a pop of 72%, which means a probability of profit of 72%. And what that means is at the point of expiration in 56 days time, there's a 72% chance of us making at least 1 penny on this position. Our P50 isn't displayed for futures. However, our P50 will typically be somewhere around 85 to 90%. So we're looking at probabilities of success between 72 and 85 to 90%. And that's before taking into account that implied volatility is typically overstated. So in actual reality, our probabilities of success will be a little bit higher than that. Now, this is where we get to the good stuff. So we can sell these contracts for 0.00460. The contract multiplier on this, I believe, is 100,000, just off the top of my head, which gives us a max profit of $460. So we will collect $460 upfront as soon as this position gets filled, and our broker is only going to require us to have $641 in our account, or it's going to require us to have $641 in buying power. If you have $641 in your account, you should not be using all of it on one position, but $641 in buying power. So if you look at our return on capital here, we've almost got a 100% return on capital on a naked strangle position with an extremely high probability of success. Now, you can only really get this with futures, or if you have a portfolio margin account, you can get it on equities, but most people won't have a PM account. So We are looking at very, very high probabilities of success, very high returns on capital, and also, just as a little side note, futures is not included in the pattern day trading rules. So if you do get into a position and you want to get out for any reason the same day, you can do so without it going against you if your account is smaller than $25,000. But the way that we trade, we're trading months out in time. So if you put a position on in the morning, say, there isn't really anything that will happen in the market that will make you want to close out that position or make an adjustment on that position within the same day. So PDT rules don't really apply to us anyway. But just as a side note, futures aren't even included in PDT rules. So we've got a very high return on capital. Now let's just say you didn't want to allocate $641 to this position. Let's say you didn't like this unlimited loss potential. You wouldn't actually take an unlimited loss if you know how to manage risk correctly. But let's just say you didn't want to do that because futures are very, very big products. So you do want to keep that in mind. So what you can do is you can just buy another contract, use some of your premium to buy another contract a bit further out, do the same thing on the put side. So you buy a contract a little bit further on the call side, buy a contract a little bit further out on the put side. And what we do here is we define our risk. So we now have a max loss. Now, if you look here, our buying power requirement is $130. Our max loss is $370, and our max profit is $130. So we're actually getting a 100% return on capital here, provided that everything goes smoothly, which it will do 66% of the time. We have a slightly lower probability of success now because we've spent some premium on buying these contracts, but we still have a very high probability of success. We have a slightly higher return on capital, and what you can do is simply just go a little bit wider if you wanted to collect more premium. As you'll notice now, our buying power requirement is 200, our max profit is 220, so we have an even higher return on capital. Our probability of success has increased, but our max loss has also increased because our spread has increased. You can be a bit more aggressive and go in a little bit on your short strikes and collect more premium, get a higher, nicer return on capital. If you look here now, our max loss is 320. We're collecting 180 in premium, and our buying power requirement is 125. So futures is a hack. Just keep in mind that the size of these futures underlyings are massive. So just keep that in mind. Don't go too large on your positions, but absolutely, futures has a place in every portfolio. It's too capital efficient for you to not have futures in your portfolio. So the only thing left to go over is to look at how much buying power should you be allocating to your positions. Well, we've created a free position sizing template for everybody to use and get a hold of. The link will be in the description. Just click that button and it will take you over to the spreadsheet. The way it works is you enter in the size of your portfolio. Say you have a $50,000 portfolio. You can then enter in whatever the current VIX level is, and everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you're following this over the long run, there isn't any one event that will wipe you out. So the aim of being in this business is you want to stay in business. Okay, the edge is built in as soon as you write the contract. As soon as you're collecting a premium, the edge is built in. It's your job to stay in business, and this will help you do that. If you want to learn in more detail about what we do and how we do it, click on EDS Premium. The link will be in the description. And get yourself signed up. Inside you will have access to our portfolio, so you can see what positions we're placing, how we're managing risk, how we're making adjustments, etc., all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. There's a private community. Well, it is a private community, so you can speak with myself directly or with other like-minded individuals if you get stuck. And there's a 100% money-back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are. Or you can simply request a full refund. So it's completely risk-free, and it's £1 a month to join. It's so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill of being able to write contracts, manage risk, and make adjustments all profitably. And we aim to get you to a point where you've learned the skill and you know what to do without any external help or influence within 6 to 12 months. And it's something you could take with you for the rest of your life. So you are always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.